Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money.
I'm Evan Barnard, filling in for Paul Winkler. Again, if you have some questions on investing, there's tons of resources on our website at paulwinkler.com. And you can also sign up for the podcast there or listen on all the platforms that you listen on stuff. Hey, so we're going to talk, we talked about the investor's dilemma, and then why are we so interested in the investor doing well is because that helps solve the global dilemma. Prosperity solves a lot of problems that poverty can never solve. And so how do you build a portfolio so that you aren't worried about all of these things that are going on in the world, whether they're wars, COVID, storms, and so forth? So let's talk about how to engineer a portfolio and what's, just engineering for in general, because it is the backbone of an efficient portfolio. The way something is engineered or designed is a critical factor in how it will perform, right? I wouldn't want to fly on a plane, designed by someone that was not connected with engineering, right? The risks are too high. So let's look at just a comparison before we dive into the portfolio itself. How many of you, might remember the Deep Sea Challenger? And it had a vertical design. It was built to descend quickly and has three main sections: a flotation beam, a pilot sphere, and scientific equipment. It's got special foam for buoyancy and strength designed to handle deep sea pressure, strong pilot sphere, 12 custom thrusters, and so forth. Over 180 systems for control, monitoring, lighting, cameras, and so forth. And I think ultimately some of that was used for either looking at the Titanic and just various things, but just an incredible marvel of engineering. However, if you fail to apply fundamental engineering principles, that can have catastrophic results. How many of you remember the story of Ocean Gate Titan? It was a carbon fiber hull. It was a submarine that, they kind of heard this bang and they were looking for it and so forth. And this obviously had no survivors, but it just had a carbon fiber hull and titanium design. It was lightweight, but risky under deep sea pressure. There was no independent certification of the construction process. They skipped third-party safety checks, going against standard deep sea engineering practices. It had a risky shape, material flaws, and weak testing. And in fact, I think there was one piece where it was controlled by like a Nintendo or a not GameStop, a Logitech game controller. And so that's not how you want to construct a portfolio, is something willy-nilly. So what do you want to pay attention to? Well, there's three main factors when you're looking at building a portfolio. And the first step actually is, how much stocks do I want in the portfolio relative to the fixed income? Treasury bills, government bonds, corporate bonds, and short-term bonds and so forth. How much stock versus bond mix? Because that is going to have the greatest overall impact on the volatility of a portfolio. You could have a phenomenal stock mix, fund mix, whatever you want to call it, but if 80% is in fixed income, that's going to dominate the risk and return of the portfolio. That doesn't mean it's bad. It just means it exists. That has a big effect. So once you make that decision, now how do we build a portfolio so that we maximize the return for that volatility that we're accepting? And as I go through this, I didn't create this. Paul didn't create this. Several different people that have won Nobel Prizes over the years came up with this. We just use the research and remain flabbergasted at why the industry doesn't use this research. They do talk about it a lot, but they implement the research with actively managed funds or stock picking, and that really throws the results of the data out the window. So what are we looking at? Well, first off, we talked about is the equity premium. Stocks make more than bonds over the long term. That's not a big surprise, and that's certainly not why Fama and Eugene Fama won the Nobel Prize for coming up with some of these issues. But on average, equities outperform fixed income by about 7.6% per year if we just go back to 1964. Depending on your time frames, it would vary a little bit, but usually it's between 7 and 8% return above bonds. So obviously I'm going to have more volatility if I have those stocks in the portfolio, but I'm getting paid for that risk. So now I say, okay, I'm going to have 70% in equities. Now I go to the next factor, which is how much small companies versus large companies do I want to have? Large companies are, in fact, the safest equity, large U.S., are basically the safest, lowest risk equity category over time. And yet, most people are heavily concentrated in those, and they are the lowest performing equity category over time, not because they're bad, but because they're so big and so safe. I'm not demanding a higher rate of return because I'm not taking a lot of additional risk. So you do want to add small companies into a portfolio. Why? Well, small companies have a lower correlation with large companies, and so you're not going to have everything going up and down in the portfolio at the same time. They may go the same direction. Like in COVID, we saw all the equity categories decrease, but that's why you have fixed income to rebalance with when that happens. So small companies are riskier than large companies. No question. They're not sitting on $8 billion of cash to weather the storm. If they have a product problem, they can still make payroll and all that. Small companies don't have that luxury. And investors, as we say, aren't stupid. If I'm going to invest in small companies, I'm going to expect a higher rate of return. And so that's what we call the small premium. And small companies actually outperform large companies on average 2.5% to 3% per year, depending on the time frame that you're looking at. But why do I call it a premium and not a guarantee? Because there are years where large does better than small. And there are 4 or 5 year periods where large does better than small. And then there's years where small trounces large. That's why you want both. And when you have one that is outperforming at the time, again, what's the fundamental rule of investing? Sell when prices are high, buy when prices are low, and you just rebalance. And then that's a third factor of value companies. Now, a lot of times when I'm talking with someone for the first time, for the first couple of conversations about value companies, the mental picture is something that is undervalued. Like, I don't know what it's trading at, but let's just say Walmart's $50 a share. It could be $300. I don't know. But they're thinking, well, I think Walmart should be $60 a share. If it's only $50, it's undervalued. That's not what we're talking about. That's a stock picking term. We're talking about an academic measurement of what's the stock's price relative to the book value of the company. The lower that number, the more you're just paying for the bricks and mortar or the real estate and not the fact that they make computers or chips or software or donuts or cheeseburgers or whatever. When you see huge growth companies, they have grown. And so now they're safe, big growth company. I'm not really getting compensated as a group. There are outliers and everyone knows those names, but it's always after the fact. No one knew to buy Palantir, let's say, 15 years ago because they hadn't, had this huge upswing. And that story goes on all the time with stocks. We focus on the survivors. So a value company just has a very low price to book, which is just an academic number. Normally, the price to book for large U.S. stocks is around 2.4 on average. It's been a little bit higher recently with some of the FANG stocks growing in the Mag 7 and so forth. But value stocks might be one below that at 1.4, 1.5. Well, if a company is in trouble, that's going to be higher risk. And again, if I'm going to invest in companies that are in trouble, just to use that language, I'm going to expect a higher rate of return. So I want to use those factors to begin constructing a portfolio. Why am I going into this detail? Because this is actually what it takes to have a portfolio that will weather the storm, just like the Deep Sea Challenger versus the Titan, Ocean Titan, is I'm not worried about, what happened to oil prices? What happened to war in Gaza? What happened with COVID? I have enough categories across the board that I can take advantage of or be protected no matter what comes down the pike. And ultimately, that leads to having a bunch of different categories that have different correlations, meaning they don't all go up and down at the same time. And I always have something that I can rebalance with. And, again, this process won the Nobel Prize. This discussion, the last 13 minutes or so, probably is a semester college course to actually dig into a lot of these things. But most people, as we talked about with the investor's dilemma, they get overwhelmed with information or overloaded. They shut down and make an emotion-based decision. This is how you avoid that process. And once you have it in place and just continue to rebalance, then you're going to be fine. Yes, there's still going to be volatility. It'll go up and down. I'm not saying this is a risk-free process to the extent you have any equities in a portfolio. But here's the other piece of this that I want to touch on before we have our final segment is I was in a gym. I think I talked about this last week, but I was in a gym a couple weeks ago when I was traveling, and I was on a treadmill. And, this was a gym. I felt like a fish out of water. This was a gym where these people were hardcore working out. It wasn't like, the nice gym or something like that where you just go to hang out. And I was on a treadmill, not on the weight machines that some of these guys had. And, there was just all kinds of equipment. And very easily you could see that the people that, had a game plan were getting results because they had, they knew which piece of equipment they were going to use next, how many reps was I going to do? They might have had a coach, either spotting them or helping improve their form so that they got the most benefit out of working out there. And so, we always talk about the benefit of a coach. Once you build a portfolio, in a lot of respects, building the portfolio is the easy part. Yes, there's some math involved. Yes, you have to pay attention, but it's really the easy part. Sticking with that portfolio when the tides turn, when economic challenges happen, when you get sick, when the dog throws up, whatever, that's when you actually need someone to help go through that process with you to make sure you don't shoot yourself in the foot. Just like we were talking about, doing things in a hurry with financial scams can cause a problem. And so it was interesting. As I close this out, there was a thing on AI fitness coaches who wouldn't accept any of my excuses. This was a writer in the journal, and basically she was trying out several different AI fitness programs, and they all had their pros and cons. But the interesting comment that had jumped out at me was the program was just accepting her excuses. If she said she didn't have enough time or was traveling, it gave her something else to do. And so, you have to take advantage of that human connection. I don't think AI is going to replace as many people as a lot of folks think.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.